Good day, trader. Welcome to our YouTube channel. So in today's video, we're looking at trade recap, the trade we took on Friday, gold buy. So we want to look at what is the strategy behind this trade and what are the components that comes together to make up this exact trade. So that is what we want to look at today. Okay, first it is just a 4 hours market structures that I use, 4 hours market structures. And if you have been following me for long, you know I use intermediate time high, intermediate time low. And if you look at the left hand side of the market, you know, gold here did a lot of fake out, a lot of consolidating, a lot of consolidating moment at this particular moment, where we have multiple consolidation. If you go to 1 hour, you see multiple consolidation at this particular point. But if you look at this left hand side, the last distribution market did was bearish. You can see that every retracement, expansion, retracement, expansion, retracement, expansion, retracement, expansion. So you can see that that is our last distribution market did. And the moment market want to change, if you have been following me for long, I said something that intermediate time high, intermediate time low, they are the outsiders of the market. They shows that they are the one guiding every short time high, short time lows. You look at these distributions here, you can see that there is an intermediate time high at this particular point here. There is an intermediate time high. And what is an intermediate time high or intermediate time low? Intermediate time high, intermediate time low is when we have a lower high, that's a higher low here. We have an higher low by the left, and we have an higher high at the middle, and also have an higher low at the right. So which means that this exact here is what we call the intermediate time low. They are the outsiders of the market. And if there is an intermediate time low, intermediate time high being created, it means that there is a opposite intermediate time low for liquidity, because every intermediate time high always look for liquidity on the intermediate time low. So which means that when this is created, where is the intermediate time low? We have the intermediate time low here. That's the first liquidity zones. You can see it here, a lower, so we have a lower low at the middle. So this opposite intermediate time low, because you can see a lower low at the middle, a lower high at the left, a lower high at the right. You can see it here, 1, 2. So that is intermediate time low. So when intermediate time high is created, it will always look for liquidity on the intermediate time low. So which means intermediate time high, intermediate time low are the outsiders of the market. And if you look on daily chart, you will see that this low here is actually an outsiders. So all these that happens here are just internals. So the externals, intermediate time high, intermediate time low, are the externals of the market. And also there's another intermediate time low here also. So you can see this high and this high. So you can see the market go for 2 intermediate time low in the market range, and that is where. So we also have one here. So but you can see the market, the moment market took out intermediate time lows here, let me put so I can know there's intermediate time low here, there's intermediate time low here, and the last one is here. But we can't force the market to take out liquidity, right? So we just need to follow up with the market and see what market do. So the moment market creates another intermediate time low in this price range, it shows that that is the end of the distribution, because you can see that market creates another intermediate time low here after market took out the liquidity. So market take another intermediate, create another intermediate time low. You can see a lower, that's a lower high at the left and a lower high at the right. So the moment market break this structure here, you can see that the moment market break this structure, it shows that this intermediate time low is confirmed. So where is our intermediate time high? In this whole price range, this is the intermediate time high we have. So which means that in this whole price range, the moment market create this intermediate time low, this is where our liquidity should be. The market is seeking a liquidity, and you can see we have a fair value gap. So which we expect markets to come back to the fair value gap and buy. But during the whole weeks, this is almost like 2 weeks, market did not come back. Market was just trading up, consolidating, trading sales and everything. But the moment market comes back, inside it. This is the first time market come back inside of it and market buy, but the distribution was not so solid for market to come back. But you see, market enter a fair value gap for bearish, and the moment market respect the fair value gap for bearish and was unable to break up and continue high, it means that market did not want to use the fair value gap. I taught something on my mentorship book, the first line of defense, second line of defense, and first line of defense, overlapping defense, and last line of defense. The fair value gap is the first line of defense. So the main market did not use the fair value gap, and we know that we are bullish. Then the next line market is using is what? The fair value area. You can see how market trade on the body, how we weak on the body of that fair value area. So it shows that the fair value area is the next place market can use. And if you look at I gave the lookout here, expecting that okay, market has already respected the fair value gap for bearish, so the next place market is coming for is the fair value area, and that is the exact place the sellers have not traded yet. So that's why market come back there and continue the trade. So you just need to understand the market structures. You need to understand how all this how it moves. Yeah, how it moves. You can see it here. I won't expect the buy from the fair value area. I gave out the buy from the fair value area. I know a lot of people will not take the buy from the fair value because of the stop loss and everything. You can see how I gave it out just even before all these stuffs occur. But you need to understand that that is the exact way you need to look out for the market. Looking at the fair value area, where is market going to? You need to understand the bias, and the bias of the market is the draw on liquidity plus direction. Where is market going to? Are we seeking liquidity, or we are offering a fair value? At this particular point, the whole sale the market is doing here is just to offer a fair value. That's just all. So the moment market get to the fair value area, then market become a buy back. So how I took the trade, how I took the buy trade on gold, how I took this buy trade on gold here is that now looking at this whole internal structure, you can see that market breaks. I want to start from the current trend. There's something called the current trend. So the moment market break this low, create a fair value gap, and market trade from a fair value gap too. Market trade from a fair value gap and break the structure and also create a new fair value gap. For if this fair value area did not work, it did not want to work, it means that market will use this fair value gap for sell and continue the sell. That is what the fair value gap is used for. But the moment market gets to the fair value gap, now it means that we have a bullish support level and we have a bearish resistance level. That is what it looks like. So which means that I just want to explain what happens here. You know, you have a fair value gap for bearish, you have a fair value area for bullish. Now this is what it looks like. I want to explain it. You know, if you look at it in this way, you may not really understand what I saw, but if you look at it in this way, now this is fair value gap for bearish, this is fair value area for bullish. So the moment market is coming up from a fair value gap and we expect market market is in the middle of a fair value gap and a fair value area, we are expecting buy from a fair value area and we are expecting sell from a fair value gap. So I want to wait to see the one that market is going to disrespect. Any one market disrespect, it means that is the one market don't want to use. If market disrespect, if market goes up like this to the fair value gap and break the low that traded into a fair value area, it means that market disrespect the fair value area. But let me double this guy too. But if market retraces from a fair value area and breaks the high that traded into a fair value gap, it means that market disrespect the fair value gap. So this is the fair value gap here. The moment market enter into the fair value gap, this is the first candle that enters. You can see a little rejection. Then the second candle, the moment market creates this large candle here, it means that market disrespect the fair value gap. So that is a fair value area where I expect market to buy from, and that is why you see so I put my take profit at the first intermediate time high here. So that is where I put my take profit, and you can see it here. So if I do 1 to 2, I should have hit a take profit, but I don't do 1 to 2, I did. So you can see it here that if I use 1 to 2, I will have hit a take profit here, but I am using the first intermediate time high. So we have another intermediate time high here. So that's the reason why I'm using this as my draw on liquidity, because you can see it here. We have a high here or a high here, and also an high. So we have a swing high here. We have a swing high here, and also have a swing high here at the right of it. So that's an intermediate time high. So that's my first take profit, and you can see if I use 1 to 2, it will just be 440 pips, and that will have been the take profit. But you can see it here. Let me just try to you can see it here. That's almost 500 pips. And let me show you the first one, because I took the first one too with the VIP. I took the first one. So you can see the first one here. You can see how I took the first trade using the fair value area, and you see it is an expectation from the fair value area where I expect that market should buy from the fair value area. The second trade is the one I took from the Ifvg. That's the inversion fair value gap. Inversion fair value gap is just about if there's a bearish fair value gap for market to use for bearish continuation, and market disrespect it. I don't mean if market did not respect it at all, like there's no respect at all. Assuming there is a rejection from the fair value gap, a little rejection, then it is not an Ifvg. But because there is no rejection, market swept it with a lot of high momentum. That is why I expect market to come back there. And you can see that I did not just use the high of the Ifvg, I used the middle. Yeah, because I expect markets to come back to the middle of the Ifvg, not the high. You can see what I use. I use the middle of the Ifvg. That's the inversion fair value gap. I use the middle, not the high. So that's just it. Let me show you the beginning of this one. So you can see it here. How I expect market to come into the fair value gap, the bearish fair value gap, and comes to the fair value area for buy continuation. So that is the expectation, and that is almost how many pips? That's almost how many pips? Let me check. I'm using this. That's almost 1,200 pips plus. So that's it. That's the way I took the trade. Thank you so much. Don't forget to like, share, and subscribe. And also, you want to follow me up on the Telegram channel, link in the descriptions, and don't forget to drop a comment. Just drop what do you feel like, or what do you see, because we trade based on our belief, we trade based on what individually sees. So the market is a large environment that everybody trade based on what they see. Thank you so much.